Okay, welcome to another installment of IJS Speaks. This is your neighborhood financial economist, KD Mark. Today is Saturday, February 27th. It's 1:17 p.m. Eastern Standard Time. Okay, so this week was an interesting week. Definitely got a lesson in the relationship between stocks and bonds, and especially when it comes to the influence that the Fed can have on those markets. So what we saw this week in a nutshell was we saw a sell-off in both stocks and bonds at the same time. The narrative behind it kind of weird, but basically bond yields are rising, so investors are selling off their stocks because the discount rates are changing and the prices should adjust. That's one way to look at it. But I think another aspect that needs to be considered is the fact that since the end of the great financial crisis in 2010, 2011, if you had a late start, quantitative easing in monetary policy, not just at the Fed but around the world, has been pushing up stock prices this whole time. So for the last 10 years, maybe 11, depending on how quickly your segment of the financial markets responded to the Fed's policy. But for the last, let's just call it 10 years, the stock market has basically been going straight up. And it has been due to a lot of the liquidity that the Fed has been providing through through their quantitative easing, which bleeds into financial markets. Now, typically with portfolio theory, you get the whole, not even 60-40, but maybe 40-40-20, right? Where there's a mix of stocks, bonds, and a little bit of cash. What you tend to put those types of simple portfolios together because stocks and bonds are supposed to theoretically move counter to each other. So, for instance, on a day that you have stocks down, you typically have bonds up because investors are buying safety in the fixed income market. And vice versa, when you have stocks up, investors sell the safety of the fixed income markets to buy risk in equities. Which, simple enough, makes sense. But, like I said, what we ended up seeing, and especially towards the end of the week, was that both stocks and bonds were selling off simultaneously. Which, basically just looks like investors were just fleeing financial markets and going to cash. And we also saw a corresponding spike in the dollar index. So, lends a little credence to the idea that investors again were just seeking liquidity in all financial markets. Also saw gold selling off, which tends to act as a safe haven, but in this case, it was actually trading in line with the other risk assets. So that's but again, I think the change in sentiment that I think the market is experiencing right now is, well, let's start with this. When Jerome Powell, well, go back even further. The Fed has been saying for quite some time now that because realized inflation has been below their expected target for close to a decade, maybe more at this point, in response to that, they are willing to allow realized inflation to go above the 2% target and stay above the 2% target for an extended period of time, so as to make the long-term average equal to their target of 2%. So we've been below target for a decade now. The Fed is going to let inflation stay above their target for a long enough period that the average over time is equal to 2%. That is what they're trying to accomplish. To that, Jerome Powell, the chair of the Federal Reserve, says that higher interest rates, higher yields on bonds are welcomed as a vote of confidence. And market participants immediately went to work challenging the Fed. So bond prices, bond investors started selling, pushing yields higher. I guess basically trying to see where or at what point would the Fed step in and start buying. And as far as I can tell, they haven't. I'll talk about this a little bit later in the forecast part of the podcast, but the 10-year Treasury, it ran all the way to a long-term support level, and now it's looking like it's consolidating. So I don't necessarily think the Fed stepped in, but with Treasury rates hovering around 1.5%, it's a round enough number that maybe that was on some level monetary the monetary authority stepping in and kind of halting the run up in bond yields. So we'll see how that plays out. But looking at my longer term charts, it looks like the 10-year Treasury has found support. So we'll see. I can at minimum expect consolidation, and at best expect some kind of reversal, albeit short term. And then I'll also talk about how that may or may not play out through the rest of the financial markets. So let's jump right into the trade book. Oh, well, before we even get to the trade book, about the Fed with the stocks and bonds. So the overarching theme, I think, going forward is that the equity market in particular, knowing and understanding that its levels have been supported largely by monetary policy, and now we see signs that the Fed is willing to let market rates tighten or market spreads tighten. So basically allowing market rate movements to effectively tighten policy without them having to act. I think now equity investors are becoming a little bit skittish. I do think they realize that there are more days of accommodative monetary policy behind us than in front of us. And each day that passes brings us closer to a day that monetary support from central banks will start to be removed from markets. So I think that's what we're noticing. Those are the cracks that we're hearing in the ice under the equities market. But as far as it just collapsing starting with the next trading session, I don't think so. It does look like there's a little bit of buying support coming in into the equities market. So if that corresponds with what we're seeing in the bond market, 10-year Treasury market, then going into the next couple trading sessions, it may not do that bad. But onto the trade book. So it's been maybe a week or so, 2 weeks maybe, since I last recorded. I've been buying and selling the same things because I've been having success with them. What I'm currently holding on the trade book are a couple of currency futures and some soft commodity futures. I was also again looking at longer term support and resistance and seeing the S&P 500 break below a long-term support level. I was convinced that I should put on a put strategy because the S&P looked like there was room on the downside now that a old support level had turned into a new resistance level. That was in the first half of the week. By say Thursday, I was able to. I wasn't able to, but I chose to get out of the put position. Took profits on that, and just based on share momentum, I had a couple put verticals on the 10-year Treasury as well, and was able to take profits on those. They had another week on them to expiration. Both the SPY puts, the SPY put verticals and the 10-year Treasury put verticals, they all had about another week on them. But again, looking at where the 10-year Treasury was in reference to its longer term support and resistance levels, and then also looking at the type of correlation that was playing out between the stock market and the bond market, I was convinced that I should get out of both of those positions in anticipation of some kind of a consolidation which may lead into a reversal. Gold, on the other hand, as the dollar was going short and as gold was sitting on top of a long-term support level, I was going long gold through the GLD, through call options on the GLD ETF, and the positions were losing money. And even when the dollar was trending lower, the calls on gold were losing money. What I saw on Friday was gold finally broke below that support level. So that convinced me, or that confirmed that I was wrong on that trade. And going into the next few trading sessions, I will be looking for an entry point to go short gold as it tries to, in my mind, get to its next support level. And that should give me an opportunity to recoup some of the losses on the long side of the trade leading up to the breakdown in price. Okay, so that's what I had on the trade book. Sold off towards the end of last trading week, or this week that just ended. Still on the books going into next week. I've got the Aussie currency futures, the Great British Pound currency futures, and the Euro currency futures all going long. Again, that's a play on the dollar, because looking at, again, what happened, and in this case, I'm using the 10-year Treasury market as my lead, and the other markets are my follow. So taking cues from the 10-year Treasury market, with it getting to a long-term support and consolidating, and the stock market also in a consolidating pattern. The dollar index has pulled back to a long-term resistance level. So, with these markets all consolidating at major support or resistance levels, I felt it safe to put on a short dollar position through the Aussie, the pound, and the euro, which throughout the week I was able to trade. I was able to trade in both directions, actually, because at one point I had to put on hedges on the currency positions, which are basically just a calendar hedge and a calendar spread, and I was able to take profits on the front leg, and then with a quick reversal in price overnight, take profits on the hedge. So yeah, trading the currencies, it was a bit choppy, but I was able to trade both legs on a hedge position, actually. And then the soft commodity complex. So the soft commodities seem to be taking their cue from the oil market. Because going into that whole issue we had with Texas and the freeze, which we saw oil prices push higher, that week pushed oil prices above a long-term resistance level, which it consolidated briefly above, established it as a support, and is now trending higher. I've noticed a similar price pattern across the soft commodity complex. So I look at corn, wheat, and soybeans, and I was able to close out profitably a call vertical on soybeans earlier this week, as well as long futures trades, long positions on the futures on corn and wheat. With the dollar towards the end of the trading week pulling back, as well as with crude oil pulling back, I saw there was a pullback in the soft commodity complex as well. So going into next few trading sessions, my anticipation is, as oil continues higher, the dollar reverses lower, 10-year Treasury retraces higher, gold extends lower, and the stock market retrace higher, the soft commodity complex should also respond as they trade with the risk assets like stocks and crude oil. The precious metals, on the other hand, probably tying in with inflation expectations. The precious metals complex doesn't seem to have as much support for upside, which is weird because, especially with gold, it's usually tied into the inflation. The inflation hedging aspect of it is important to investors, but it doesn't seem to be trading like a safe haven as of now. Maybe that correlation changes as the year progresses, but as of now, gold is trading sometimes inverse to the dollar, and sometimes it trades like a safe haven. Okay, so the dashboard itself, all right, looking at the dashboard, I had to do a little bit of rearranging. Okay, still looking at the same 5 things though: S&P 500, crude oil futures, gold futures, the dollar index, and the 10-year Treasury futures. The two markets that, well, let's just talk about sentiment first of all. So on the risk side, I have the S&P and crude oil, and on the safety and liquidity side, I have gold, the dollar, and the 10-year Treasury. So overall, start with the S&P 500. So the momentum on the S&P 500 over the last week has gone negative. I'm sorry, the trend. The trend on the S&P 500 over the last week has gone negative. So it's definitely trending lower. Momentum went negative, but is actually rebounding. So the momentum on the price is still negative, but it's getting less negative. That's always a good sign. It has to get less negative before it gets positive. Even though the price is, the price does have resistance above from one of my indicators, and the other one, the price is just sitting on top of it. So it's not contributing to the conversation, that one. So going into next week, so okay, as it currently is, the S&P does look like it has more downside to go, but it's slowing. So unlike what we saw on Thursday, we probably won't see another huge drop, but we could see small steps progressively lower. I mean, I could be wrong though. We could just get one more huge drop and then it consolidates. But I mean, with the change in the rate of the momentum measure, it looks more like we're gonna see small steps lower until it finally just puts in some kind of a bottom end pattern and then turns around. So going into next week, from the standpoint of the equities market, as represented by the S&P 500, we can expect a little bit of consolidation with some downside pressure as the market tries to find an equilibrium level. My other risk asset is crude oil. So the trend on crude oil is positive, but it's slowing. So it's trending up, but the rate at which it's trending higher is slowing. That's usually not good. The momentum also went negative. That's usually not good too. And both of my indicators above are showing resistance. So going into next week, we can look for, being that the trend is, the trend is still positive. We can look for consolidation in the in crude oil. So it's at close on Friday, it closed at around 61.5. So somewhere within the range that it's been trading in the last week or so. So down to about 60, up to about 63.75. If it breaks out of the top of the range, that's always a good thing. That means it has momentum. It's probably going to continue higher. But as it is right now, we can expect consolidation and probably see the price stick towards the bottom of the range it's been trading in recently. Gold, on the other hand, the trend is negative and accelerating. The momentum is negative and accelerating. And both indicators above are showing resistance. So gold is in a full-on short. So like I said earlier, I'm not necessarily going to just jump into a short position. I'm going to wait for a good entry point because it already has a lot of momentum. If that momentum turns into a crowded trade and then the crowded trade unwinds, it can unwind quickly. And I don't want to be the person that buys in at the absolute bottom right before it unwinds. Even though eventually it may continue back on trend and go lower, but having to waste a week or 2 weeks sitting in a position while it loses money, that money could be better committed elsewhere. So yeah, the picture on gold right now is not good. It's looking like a short, but I'm waiting for a better entry point simply because it did a lot in the last few days. And if the dollar's influence on the price of gold gets dialed up, then with the dollar going short, we may see a pullback in gold. So maybe a pullback to test the old support level and establish it as resistance. So I'm going to hang tight on gold, look for better entry, but as it is right now, the dashboard is flashing short on gold. And on the dollar. So with the dollar, trend went positive, which is, of course, we saw that breakout over the last 2 trading sessions. So by Friday, the trend had went positive. Momentum went positive late Thursday, but has already started to peak out. So the momentum on the dollar is still positive, but it's getting less positive, which is the first step in going negative is first going less positive. Both of my indicators are showing support, so it does have support to break through. So being that there's so much support to break through, if we don't get a strong move lower in the dollar, then we can just expect consolidation as the curves kind of catch up to the new price, and then we can have some kind of a slow crossover. So it could be one of those weeks where it starts off really slow, lots of consolidating. We get a big move in the middle of the week when no one's paying attention, and then we just finish off with a little bit more consolidating. It could shape up to be one of those trading weeks. And lastly, we have the 10-year Treasury. So the trend on the 10-year Treasury is negative, but it's flattening out. So it's still negative, but it's getting less negative. The momentum is flat. So it went from really negative, and it just went less negative, less negative, less negative. Now it's flat. It's at the break even. It's at the zero line. So those are two signs that the fall itself, the overall downtrend is slowing, and the momentum to turn around is already at zero. Then looking up at the price, my layover indicators, both of my layover indicators are showing support. So we have support, and momentum about to go positive, and the trend is getting less and less negative. So that's in the 10-year Treasury. So that's basically the curves that I'm looking at on the 10-year Treasury. The regression curves are basically telling me that this thing is turning around. So if I see a corresponding consolidation and reversal rippling through financial markets, then we should see stocks move higher, crude oil move higher, dollar move lower, and gold is still kind of like up in the air because it's running on its own fundamentals, right? Actually, not even. It's running on its own technicals right now, so it may not necessarily be paying attention to other cues coming from the rest of the financial market. But that's the dashboard. So overall, as we ended the week, the dashboard would have been flashing risk off. But the way that the market prices are shaping up, or were shaping up to the end of the trading session, if those processes continue, then we're basically looking at 1, 2, 3, 4, at least 4 reversals and maybe a dead cat bouncing gold. And actually, no, it's not even a reversal in crude oil. It's just a consolidation and an extension higher. So you see a consolidation and an extension higher in crude oil, and let's call it a retracement in stocks, a retracement in bonds, and a reversal in the dollar. And that reversal in the dollar may or may not influence gold to give you some kind of a dead cat bounce back up to about 17, call it 75, before it just continues on its merry way lower. Okay. So now that's the dashboard. Again, the dashboard only looks at about a week's worth of price data. But for my forecast and my longer term targets, I like to zoom out a little bit. Same five instruments though. Still looking at the S&P, crude oil, gold, the dollar, and the 10-year, but just looking at more data for more of a sense of context for what the prices you're doing. Again, we'll start with the S&P. So the market got to a long-term resistance level, which was right around 3,900. And it spent enough time above it that I was somewhat convinced that it was it represented support, so a switch from resistance to support, and the market would continue higher. Towards the end of the month, not so much. So we get this pullback. The S&P 500 is now below. Once again, it's now back below that resistance level. So it did so the 3900 level basically held as resistance. The market can do two things from here. It can once again test 3900 level. Maybe this time it can break through, hold it as support, go higher from there. If not, it may have a tendency to retrace back to about 3730. That's a ways away. So but for the equity investors out there, if we can't see a lot of upside momentum, definitely look at your hedging strategies a little bit closer, because a good downside target from here for the S&P 500 would be about 3730, 3725 on the downside. And then if it breaks through that, then we're looking at a little bit above 3500. And no one wants to see that. It'll basically take you back to about the levels we were last summer. So, S&P 500, depending on the momentum, if it can push higher, break back above 3900, then we're back off to the races. We're looking at somewhere about 4,000, 4,050 on the S&P 500, maybe even 4,100, if it can get back above 3,900 and stay there. If it can't, on the downside, we're looking at 3725. If that breaks, we're going back all the way to last summer, back down to about 3525-ish. So that's the outlook for the S&P 500. Crude oil is looking good. So again, looking at longer term charts, it broke through the 60 level, which was a longer term resistance level. So now we'll see if it can hold it as support. If it can't, it pulls back down to about $40 a barrel. That's on crude. If it can hold above 60 as support, the next target for crude is about $77 a barrel. And it can do that in short order. And that's crude oil. And again, it's breaking through not only horizontal support, but there are also some diagonal supports that are being broken as well. So crude oil definitely seems to have the wind to its back, and it is pushing higher. Gold, on the other hand, like I said, I had to this week reframe my view on gold. The price pattern I was looking at on gold and anticipating for gold was a move higher, and that assumption was, I guess, it was an easy one to make with the inflation narrative that's being accepted by financial markets. But what like I said, what did it for me, what definitely tipped me over the edge, was the fact that at this long-term support level on gold got broken. And usually when we see that, the price tends to to have the momentum to break a long-term support level, it usually has the momentum to keep going lower. Now we could also have one of those situations like with the S&P where the price briefly breaks above a resistance level, but it doesn't hold. So, being that the longer term charts are monthly charts, it will take at least a month to get confirmation on these two. But if it holds that gold has broken through support and it holds as resistance, the next target on gold from where it is right now is $1,500. So I'll be watching it. I'll be watching the shorter time frame patterns, and now my bias on gold is to the downside. So those are the trades that I'll be looking for. So that's my outlook for gold. As of now, gold looks like a short, which is fine because up until I saw the breakdown, I was going long and losing money. So let's see what the price does now that it broke down through its support. If it can keep going lower, I can be a little bit more convinced in getting on board a short gold position. And then there's the dollar. So looking at the dollar, going back the last couple months, it's been, steadily stepping lower. And it is right under a long-term resistance level and just above a long-term support level. So even with the pullback that we saw on, Thursday into Friday, it still puts the price just under that resistance level. So if, as expected, we can see a reversal in the dollar, a reversal in the 10-year, stocks, crude oil extending higher, etc., the dollar should continue pushing lower towards the 86, let's just call it the 87 level. It's currently trading at, or not currently trading at, last traded at 90.93. And I'm thinking, if the resistance level that it is currently bumping up against holds, it can trade down to about 87.00. That's on the dollar. Now, if resistance is broken, this thing can easily take us all the way back up to about 95.75. If resistance is broken and then is reestablished as support. So that's the problem with, the problem. That's the problem with having to make decisions when the price is so close to a long-term support and resistance level, because a lot is predicated on what the price does around that level. So it may be difficult, but waiting for confirmation is very important when it comes to these significant levels, because it's a significant level, yes. So it may hold, more than likely it may hold, yes. But if it doesn't, then all of your assumptions that you build your trading narrative around are automatically invalidated, and you would have to unwind every trade that you established based on that narrative. So trading around these types of price levels can be tricky, because a small move in one direction or another, which you may not be able to get confirmation for until, several sessions later, definitely does. It can basically flip your trading narrative on its head. But overall, I started trading the soft commodity complex because they seem to better represent the inflation or inflationary narrative that's being adopted by financial markets. Because while you have bonds selling off and stocks selling off, you have commodity prices ticking higher simply because those markets are driven by supply and demand fundamentals versus dislocations and distortions created by monetary policy. Now, another thing worth noting, and again, this isn't me forecasting gloom and doom, but another thing worth noting, which, by the way, when I first started in the financial services industry, which is about 2008, perfect timing, by the way. Well, let's call it end of 2007, beginning 2008. While we saw other markets sell off, you saw real estate, you saw stocks, you saw bonds, all these other these markets are selling off. The one market, the last holdout, was the commodities market. And again, that was represented by oil prices and by the price of gold. So while we saw a sell-off in stocks and we saw a bit of a sell-off in bonds, and then, of course, the rally in bonds as the Fed started messing with interest rates and started quantitative easing and all this stuff. But the commodities market, especially crude oil and gold too, we saw a flood of money entering those markets and just bidding those prices up. Now, of course, they both resulted in a collapse or a crash in those prices. But it's just interesting to note that we're again at a point where we're seeing other risk assets and some safe haven assets selling off, and where can you put your money if it's not in stocks or in bonds or in gold, in commodities? So now, especially for the soft commodities, because they're tied into population growth and food consumption, I definitely think as we try to lift the standard of living for more people around the world, the soft commodities should benefit from that. And then we're talking about, reopening because vaccinations are going relatively well. So, that's more activity, that's more production, more consumption. So I think that all bodes well for the soft commodity complex. Industrial metals should as well benefit because more production, more manufacturing, more consumption. Precious metals, they're looking kind of weird right now, but it's just some markets are going to be distorted because of an unwind of monetary policy, the same way that some markets were distorted in the wind-up of monetary policy. And it should be noted that it may not be the same markets that are affected in the opposite direction as for the unwind as it were for the wind-up. So that should keep things interesting for market participants going forward. Definitely, if you happen to know a financial economist, get in contact with them, have a conversation, find out, what their take is on the economy, and definitely what types of distortions the Fed may inadvertently create in financial markets by virtue of them exercising their policy. And on that note, we'll wrap it up. If you have any questions, comments, or concerns, you can always reach out to me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. Also, if you're interested in learning more about technical analysis and charting, feel free to visit me at rtn.education. That's rtn.education. Just type that in your browser, hit go, and it'll take you to a site where you can access a myriad of resources to get you a better understanding of technical analysis and how it can be used to make you a better trader and investor. Okay, and on that note, when in doubt, take profits. This is Katie Mark, your neighborhood financial economist, signing out.